You're listening to Shoe In, covering the ins and outs of all things footwear, from sneakers to heels, loafers to slippers, and every type of shoe in between. Brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. And now your footwear insiders, Matt Priest and Andy Polk.
It is a simple economic fact that if you do not have money in your pocket or available debt on your credit card, you cannot buy shoes.
Oh my gosh, this available debt on my credit card, that's all you need.
It's the most key thing is the available debt. And if you don't have available debt, folks, you can open up a new credit card to find new
and you get a free t-shirt to boot at the Brickyard at NC State. That's where most of my credit cards are signed up for.
Until they stop the college kids from being able to get their credit cards. The genius thing was you used to be able to transfer the whole amount and have a 60-day kind of free grace period.
I remember.
Until the interest went from your old card at 15% to the new card at 25%.
Yep, I remember
and
that.
And then Payless Loan said, hey, wait a minute. We're the ones who rip everybody off. Get in line.
Man, I went, just thinking about that, Andy, gosh, that takes me back. I went from one scheme to the next. My first scheme was getting CDs for a penny, right? 12 CDs definitely. For a penny. And then using someone else's name, Chris Priest, for another set of 12 CDs for a penny with BMG Music Group. And then I went to NC State, and I had credit cards and free T-shirts and et cetera, et cetera. Jasmine, were you in on this at VCU?
Not at all. I stuck to one credit card, and I barely used it.
She's a good girl.
I really did. I've thought about opening up multiple, but I was just like, you know what? I got one trouble, and I'm just keep it right here.
She's an economist. Perfect employee.
I have a pretty high credit score. Yeah.
Good job.
Wow,
nice work.
Congratulations.
Yeah.
You're exactly what the credit card companies are not interested in
I know, exactly.
At all.
No interest for them, no interest in you.
Yeah, that's right. All right. Well, speaking of economics of our youth and available debt.
Right.
I hope we still have credit with the footwear industry listening to the Shoe In podcast.
Nice.
I'm sure we do. We're growing strong, and as we hit 2019 in full stride, we wanted to start one of our newest episodes this year talking about the economic picture, both for shoes, the shoeconomy, if you will.
I like it.
And then also the broader U.S. economy. And as we look forward, what we can expect in 2019. And to do that, we have a very special guest today. I think he's not been on our show before.
I don't think he has
which I'm
either.
kind of surprised.
But he is like one of our partners in crime.
He is the bedrock of our data. So we're only good as Gary says we are on what he's given us. So.
That's Gary Rains, FDRA's chief economist. Gary, only economist, Gary. Chief among one.
I dabble in the dark arts. I make predictions and Gary laughs at me. So
Gary, welcome, man. Welcome to Shoe In.
Hey, thank you, folks. I appreciate the opportunity to be here. You know, talking about the glory days back at State. I remember Art Imitating Life that was taking a grad class in macroeconomics or something, and the textbook was an outrageous price until someone found it on Amazon.co.uk, to where the exchange rate was very favorable at the time, and all of us ended up buying our textbook from the UK version of Amazon and not paying near as much as the US version of Amazon at the time.
That's the nerdiest economic story I've ever heard in my life. Hey, you're perfect for this job.
Well, I bet at that time you had to like seek that out and find it, and now it's at your fingertips, right? You hit like Google Shopping, and then it compares like 1,000 different sites to find the right price. So
yeah,
retailers have to be on their game.
AI is taking out Gary's need to shop around at the .uk.co. For
bloody hell, we're
overpriced.
sending so many textbooks over.
So happy New Year, Gary. It's amazing,
Well,
2019. And we want, as Andy said, we want to kind of pick your brain on what you expect. Can we expect a lot of this sound for footwear companies, or what do we expect? Let's start off kind of broader economic indicators and then go from there.
Sure. Well, certainly, I think as everyone has seen and heard in the news, of course, the unemployment rate is very low. It's right at the lowest it's been since the late 1960s, floating right about 3.7% for the last 3 months or so. Of course, with a low unemployment rate, you tend to see very high confidence. And indeed, we're seeing consumer confidence and consumer sentiment two similar but different gauges that are near the highest that they've been in years and years. Of course, everyone is confident because everyone is employed. We're seeing wages, tick a bit higher, and that is a surefire recipe to see the Fed to begin to, if not so much raise rates or continue its a track of raising rates. Oftentimes, it does precipitate a recession sooner or later. And in fact, I was looking at some charts just the other day of overlaying recessions in the United States and unemployment trends over the last 60 or 70 years. And it's really, really curious that we've seldom seen the unemployment rate so low without seeing a recession right around the corner. So certainly,
while really interesting. Wait, say that again.
Sure. When you tend to see the unemployment rate get so low, like it is now, you tend to see a recession percolate sooner or later as this comes to pass. No, it's not a tail wagging the dog kind of thing. It's an indirect consequence. But sure enough, when you see a low unemployment rate, usually maybe within a year or so after that, a particularly low unemployment rate like we have now, within a year or so after that, you tend to see the economy fall into recession.
Wonder why do you think that is? Like, what's the?
Well, sometimes, of course, the Fed has a dual mandate to keep both the economy humming along and also to keep unemployment low and to keep wage pressure contained. Well, to keep unemployment low and wage pressure contained, that's a bit like flicking the light switch on and off at the same time. Have it on, but don't have any lights, so to speak. Really, it's a fine line to walk to do both at the same time with that dual mandate.
Right.
The Fed, God bless them, has done a really wonderful job the last several years coming out of the Great Recession nearly a decade ago in working toward that. And sure enough, we see the lowest unemployment rate now, like I said, in nearly 50 years. And of course, we're beginning to see some wage pressures mount that eventually could translate into higher consumer prices, further down the supply chain. Not really a big issue yet, but certainly something to keep an eye on. To keep those wage pressures, those inflationary pressures contained, of course, the Fed has begun raising interest rates. And again, this is a bit like chemotherapy, that you want just enough medicine that you don't kill the patient, so to speak. And it's a bit like that with the economy, that they raise interest rates, which of course tends to slow down growth in the economy, which, again, you don't want to kill the patient, but you do want to kill the cancer.
But they've done a pretty good job so far, I'd say, right? I mean, they haven't really jacked them up that much. I mean, I remember in the past, Greenspan would, jack it up almost a full point, whereas nowadays we see quarter basis point increases here and there, and then they're using different types of tools at their disposal to change different policies and lending rates. And then I guess too, the other thing is this changed is we have a lot of stuff that's a lot cheaper than it used to be. Televisions aren't, thousands of dollars. Now you can get a 50-inch screen at Black Friday for $200. So
absolutely. The Fed, perhaps out of a consequence of the calamity from a decade ago, the Fed had to begin using non-traditional tools. I get into the whole quantitative easing issue. So, of course, since they had begun using these non-traditional tools, they are going to have to slowly take these non-traditional tools off the table, so to speak. You can think of it like the non-traditional flavors of punch in the punch bowl. If they take the punch bowl away. So, of course, yes, they're going to take more of these non-traditional tools away, slowly but surely. And again, they don't want to kill the patient, but they do. They will have to take those away. And of course, the Fed has been slowly but surely raising rates. Here the last year and a half or so. And I think the Fed will continue to raise rates on into 2019.
Gary, let me ask you this. Let's focus in on footwear. One of the things that I've seemed to have come to an understanding is the fact that footwear doesn't always track with, footwear sales does not always track with recession and or, economic growth. You could have a year where there's a recession, and so people are starting to kind of not buy maybe appliances or TVs or other things or automobiles, but they might still be buying footwear because, one, it's a necessity, and two, you can do a little splurging and not break the bank on a pair of shoes. Am I wrong? Are there strong correlations? I mean, I'm trying to tee it up to where, okay, if a recession is coming and we start to see some slowing of growth of the U.S. economy, is that a foregone conclusion that footwear sales will follow?
Great question. Yes and no. Looking at the history of U.S. economic growth and contractions, of course, the Great Recession, 9 or 10 years ago, indeed, that corresponded real well with a sharp contraction in shoe store sales in the United States. I think back in 2009, the industry contracted, sales contracted something like 4.9% from 2008. Really sharp decline, the sharpest in recent memories. Now, that having been said, since then we've seen pretty consistent growth in shoe store sales until last year. And even though the economy grew robustly last year, shoe store sales contracted about about 1.1% last year, the first time since 2009. So yes and no, both, that when the economy tends to do very well or very poorly, you tend to see shoe store sales do similarly well or similarly poorly, but not universally so. Again, last year when the economy did well, shoe store sales still contracted in 2017 from 2016.
Which is what we predicted, Gary. If you remember, we put out a paper on the post-election year malaise that the shoe industry has historically found. That there's a lot of discussion about the ramp up in an election year because candidates are talking down the economy and people are anxious about the new administration or new leadership. But what actually comes to fruition on average is a softening of the footwear economy, the shoe economy in the year post an election year, and so that's what we have, right?
What was that handsome economist name that did that paper?
I don't know. It rhymed with Larry Paynes, but Larry's not here. So.
Something like that. Yeah, indeed, that was one of the conclusions in the paper, was regardless of who was likely to occupy the White House in 2017, we expected to see shoe store sales decelerate markedly from the trend in the previous year. And we had pulled some data going back decades showing how that tended to happen the first year of any new administration, that you tended to see consumer demand for footwear, for whatever reason, really downshift that first year. And that was certainly what came to fruition last year.
All right, so we've covered retail. Give us your 19 prediction. Give us something bold that we can applaud if you're right, and we can quietly sweep away if you're wrong. Tell us where we're headed in 19.
I expect to see that we will see continued rate hikes. I think that is going to contribute to, as I said with the chemo example earlier, it's not going to kill the patient, but I do think the economy is likely to downshift. I think we're going to see continued growth in 2019, just not as robustly as what we have seen the last couple of years. Matter of fact, I think that trend is likely to continue the next couple of years. But as I say, don't take my word for it. The IMF and the World Bank largely concur that they expect to see gradual deceleration in U.S. economic growth each of the next couple of years. If anything, I lean a little more cautious than they are. I think we may see things decelerate a little faster than what they're expecting. Consequently, as the cliche goes, as a rising tide raises all ships, similarly a sinking tide tends to lower all ships. If we see U.S. GDP growth decelerate, or heaven forbid, even turn negative on into 2020, 2021, I think we're likely to see that sinking tide contribute to lowering all ships, particularly consumer spending on footwear. While we're expect to see growth in consumer spending on footwear again in 2018, given the contraction last year, I'm not so sure that the growth will be quite as robust in 2019 around the corner.
But you're still thinking we're going to have low single-digit growth?
Yeah, looking at the data this year, it's low single-digit growth that's likely this year. Of course, we're already pretty late in 2018 data now, and I think it's likely to come to pass, as we've been predicting for a number of months, of low single-digit in 2018. I think it may be a little bit lower single digits on into 2019.
So as we look at footwear channels, how are kind of shoe stores faring versus more broadly consumer demand for shoes? Because if you're saying we have single digit growth happening, it means that for footwear companies, channel matters more, getting it right, the right channel, but also getting the right product, because they're not just competing against each other, they're competing for the entire wallet that's being spent on entertainment and food and beverage and everything else. So what are we seeing trend wise with kind of, are shoe stores doing okay now? I mean, we hear this continual death of brick and mortar, but how are they faring right now? And then how more broadly, what's our trend line for growth for footwear more particularly? Are we going to track with the economy? Are we going to track a little bit better or worse?
Sure, great question. A couple of different facets to this question. Looking at the breakdown by channel, I think we're likely to see total consumer spending on footwear decelerate in 2019 after rebounding in 2018. But I think within shoe store sales, I think it is likely to fare a little bit worse than broader consumer spending on footwear. Now, to kind of differentiate, broader consumer spending is all footwear, whether it's happens online or in shoe stores and big box retailers or anywhere between department stores,
Right.
the whole bit. Shoe stores are just shoe stores. At FDRA, we track both this broader measure of consumer spending on footwear and also this kind of subset, if you will, of shoe store sales. The latest data showed that consumer spending on footwear had grown pretty robustly heading into the fourth quarter, and I think again it sets the stage for this low single digit growth that we had been talking about for 2018. But I think we're likely to see both downshift in 2019, but shoe store sales may see a little bit more of a downshifting to that flat to just modest single digit growth next year.
What in shoe stores in particular, because the labor market is so tight, meaning that full employment is at its highest peak in many years. What is that doing to wages at retail? Like what I know on average, everybody has different average wages across the country. There is
Sure.
a federal minimum wage that's pretty low, but for footwear, what's the average wage and what are we looking at there? As we continue down this path, obviously wages have got to increase to maintain, to keep your good talent or find new talent, right?
Yeah, great question. In fact, we had written about this on the Intel Center at FDRA.org, where we had talked about how shoe store retailers are really between a rock and a hard place in that, on the one hand, you're seeing, as you said, those wage pressures across the broader economy be bid higher and higher, and certainly that has happened across the broader retail market. But specifically within shoe stores, it really hasn't been bid up much at all. In fact, for most of 2018, we saw that the average hourly wages declined on a year-over-year basis.
Right.
It was only in recent months that they had begun to edge a little bit higher. So on the one hand, while shoe stores are feeling pressure to attract and retain talented workers to compete with other retailers, they need to bid up those wages. On the other hand, we're seeing that with the retail prices for footwear flat to lower in 2018, there's not a lot of room to kind of pass along higher wages in the form of higher retail prices.
Right.
Well, all right, so let's kind of follow the supply chain, Gary, away from employment, retail, all that kind of stuff. And let's head overseas. We've talked a lot about sourcing. We talk a lot about costing. And what are you seeing on the costing side? What are some things that folks need to be aware of in 2019 of some of the inputs going into footwear production? And then maybe we can take a quick tour around the region and talk more about some of the sourcing spots.
Sure. Well, the best bit of good news for importers, distributors of footwear is a very strong dollar. We've seen the dollar, fluctuating here in recent months near its highest in, year and a half, 2 years or so. Typically, as you see a strong dollar, you see not only lower average landed costs for products imported into the United States, but typically a strong dollar corresponds with weaker dollar-denominated commodity prices, including a range of commodities used in directly or indirectly in footwear production or footwear sourcing. My goodness, looking at everything from certainly what oil has done in recent months to rubber prices are unusually low for a number of reasons, indirectly related to oil as well. Synthetic fiber prices really come off their highs from a couple months ago. It really runs across not all commodities, but a range of different commodities indirectly due to the stronger dollar we've seen here in recent months.
All right. So what does that mean as you look to the landscape of sourcing? China is at 69%. China, the most recent data showed a huge surge, not just for China, but a lot of footwear surging. I think kind of the Trump bump when it comes to 301, even though to date there are no duties on footwear under 301, but people are still spooked. What are we seeing on the import side, and who are some of the countries that are like piquing your interest when you look at them?
Sure. Certainly, there are a handful of countries that really have caught my attention a lot this year. It goes without saying, while China is the 800-pound gorilla, if anything, maybe they're only the 600-pound gorilla now. We're seeing more and more penetration from Vietnam. Vietnam is still a distant number 2, but they continue to account for a larger and larger share of the U.S. import pie. Vietnam is up maybe some 14% in 2018 from the same period in 2017, whereas China is mostly flat. But beyond them, a handful of second-tier suppliers that I think really warrant attention. In particular, Cambodia, even Italy, of all places, and Bangladesh, I think warrant a good bit of attention. Then when you think somebody like, Cambodia, Bangladesh, maybe on a cost-only basis, that makes good sense. As we're seeing that production shift from China throughout the ASEAN region, but you hear someone like Italy, and you're thinking, well, how in the world can Italy be such a factor? Well, in fact, imports from Italy into the United States this year, footwear imports are up 19.4% on a volume basis.
Wow.
It's really, really impressive growth. Now, again, Italy pales in comparison to China. China is by several factors much larger than Italy, but it's intriguing to me to see someone like a fairly high cost, high wage manufacturer like Italy seeing their volumes grow by impressive double digit rates from 2017.
Yeah, that's really interesting. Well, there's just a lot to unpack, and I'm feeling both depressed and bullish and bearish and anxiety ridden and all the things just talking to you, Gary, and I talk to you every single day. So I think when you're walking around the show floor, we were recently at Fannie in New York. There are days that people feel really good about business, and then the next day you feel bad, and the next day you feel good. There's not kind of the sustained feeling one way or the other. And maybe that creates balance right now, but that just people are just waiting for either the other shoe to drop or for something to kind of hit that they're not expecting, and half of it feels self-inflicted from the trade stuff. So I don't know how to feel about it, but I mean, how are you feeling about 2019 overall?
Yeah, I tell you, you really nailed it. The conflicted life of an economist, to where you see, both the bullish and the bearish. You see, both extremes. That you see reasons to feel, very hesitant and gun shy, and other reasons to feel a bit more aggressive in the market. And certainly that's the case, really in any range of markets, and footwear is no different at all. Looking at the U.S., while I said we're seeing low single digit growth in consumer spending this year, it certainly is better than the trends going on in Canada, Japan, and Europe this year. So on the one hand, it's relative that you're thinking, well, gee, it's not very impressive growth here, but it certainly beats what we're seeing going on across both Atlantic and Pacific. But looking ahead to 2019, I think an issue is going to be how much we can see consumer demand grow, of course, not only across the broader economy, but specific to footwear, and by extension, if we see that growth come in above trend, above rates that we're expecting now, then that bodes well for import penetration in 2019 as well.
Well, there you have it. I mean, those are the stats.
It is what it is.
It is what it is. The worst phrase ever invented. But we all use it, right?
It's handy.
It is handy. I don't know what to say to your stupid comment. It is what it is.
It is what it is, my friend. It is what it is. It's like a mafioso thing. It's just business.
Uh-huh.
It's just business.
Yeah.
It's not personal.
Got to do that in your Marlon Brando accent.
It's just business. It's just business. You come to me with your economic stats, this and the day of my daughter's wedding. Be a man. Be a man. That was kind of bad, but
no, it was good. Actually, it's funny. Anyway, it was fashionable.
Jasmine. Hello.
Hi, guys.
Please
Welcome.
take us away from this boring
Okay.
conversation with Gary about economics.
So I got two things. When we were talking about 2019, I think there was like certain colors that were really popular for 2018, but I predict, and we'll see if I'm right, for the 2019 year that green, like a mint green, is going to be popular. Pink was like ruling the world for a long time. When it comes to any of the Crocs collaboration, a lot of theirs were pink. Nike had a lot of pink sneakers that came out. Puma had a lot of pink sneakers that came out. So I think pink will slowly die out and green will be the color of 2019. So that is my prediction. Also,
So while our money is contracting in the economy, in the stock market, we'll be expressing our green desires on our footwear. I love me some mint chocolate chip ice cream. I'll tell you that much.
Yeah, I do. They had that at Olive Garden, and I just had some of that.
Plug for Olive Garden.
Yeah.
And then the second thing is that I think Sperry's are going to be making a comeback. I think Sperry's are a shoe that, like the classic Sperry, just like slip-on boat shoe, is something that we've all seen. But they've kind of died out a little bit as the years have gone by. But now I think they did a collaboration with a fashion retailer named Noah NYC, and it's a cool collaboration. They did like a colorful, kind of almost reminds you of a kid sneaker with them. So I think like Sperry is going to kind of make a comeback in 2019. They're hopping on the collaboration train, which we talked about a lot on the Shoe and Show, like how collaborations are where it's at. So I think now that
revitalized the brand.
They've changed it around. They've added some colors. So I'll be excited to kind of see what they come up with.
Sperry's got a Jaws collaboration. That's cool.
That is pretty cool. Yeah.
I love Sperry's.
That makes total sense.
Sperry's are a lot like Vans and Chucks, right? They're classic. They come in and they go. No one needs to fret when they go. When they come back, they'll be back. Wolverine will be fine.
They're classic.
They are classic.
Absolutely. Yeah.
Sperry
So
Jaws.
those are the trends that's my prediction, and another prediction for 2019.
Nice. So we'll sweep it away when it's wrong. Not to worry.
Yes.
I predict this is the end of our show, folks. And I'm right. I heard the music.
You're like Notre Dame.
I'm Polkradamus. Polkradamus, folks. In the year 2019. In the year 2019, there will be much joy and laughter and purchasing of shoes.
And that's just on the shoe-in staff, right?
Right. I'm definitely getting a whole bunch of new shoes.
I can't wait to see what Jason
I'll say
buys.
this, no matter, and it plays into fashionability, no matter what the economy is like, if you have the in shoe and your product is good, it will sell.
Absolutely.
It will sell. Now, it takes a lot of work. People don't, consumers don't know that. People in the industry know it takes a lot of work to set up your operations, your strategy, implement it, execute it. But if you do it right, your shoe will sell.
Totally.
You will not pay too much. Shoe and Show. Folks,
What's that?
do you remember that old episode that from the factory outlet in Waxhaw where they sold furniture? You will buy too much. You don't, that was a redneck. It was
That's
great.
a local. Oh, Gary knows it.
Gary, you know that? Do you remember that?
Oh, you're going back in the day here.
Yeah, it's like 1980s. And people, I think now it's all in hickory, right?
Right.
If you want to buy your nice
Hickory,
furniture, you gotta get
China.
hickory. No, it's hickory dickory dock.
That's it.
But
Don't go
Waxhaw,
on.
just outside of Charlotte, used to have very big factory outlet stores for furniture. And that was the guy's sales pitch. If you go anywhere else, you will spend too much. And he was effective until he went out of business.
That was Gary's
Because
first
he didn't
job.
heed Gary's wise words.
He was the chief economist at the furniture
It is what it
outlet.
is.
It is what it is.
All right, folks, this is Shoe and Show on behalf of
Thank you,
Jasmine,
Gary.
Matt, and our chief economist, Gary Rains. Thanks you for coming on, Gary. I'm Andy Polk. You can hit us up at Shoe and Show on Twitter. We're on Facebook. Shoeandshow.com is the website. It has our full catalog of all our Shoe and Shows. If you want to be a guest, let us know. If you have an idea for a show that you want us to zero in and talk about the footwear industry, we're happy to do that. Drop us a note. Until next time, keep listening, and Shoe-In is out.
Shoe-In has been brought to you by the FDRA, the Footwear Industries Association focused on retail, trade, politics, and fashion, helping create and enhance conversations on all things footwear. For information about FDRA, visit fdra.org.